John Ulzheimer is known as one of our nation's most recognized credit experts. Having worked for 28 years in the credit industry, John has become one of the most prolific speakers about credit and the go-to authority on answers to credit-related questions. Credit Countdown with John Ulzheimer.
Hey there, this is John Ulzheimer, consumer credit expert, and today I'm going to answer a question. This is actually kind of a how can I get out of credit card debt question. In these videos that I do, if you've watched a lot of these, you know that I try to spend maybe 5 or 6 minutes so that it doesn't take up too much of your time. Anything longer than that, you're like, get to the point, John. This one is one of these questions that literally you could do an hour-long video answering the question, but I'm going to only pick one of the answers that are one of many answers. It's a method of getting out of debt, and the question is specifically, can you use a HELOC to get out of debt? What is a HELOC? Well, a HELOC is an acronym, HELOC, Home Equity Line of Credit. And what is a home equity line of credit? Home equity line of credit is an extension of credit made by a bank, reputable bank. It's a reputable extension of credit. It's not nefarious, but it's made against the unencumbered value of your home. So what in the world does that mean? Here's what it means. So if you have a house and it's worth $100,000, but you only owe $50,000 on it because you've either paid down your mortgage or the home is appreciated over time, or you got a really good deal, then you can borrow against that other $50,000 value of your home that doesn't have a loan against it. That's called unencumbered. And that type of loan is called a home equity loan. You can either take it as a loan or as a line of credit, almost like a credit card, where you can use it, pay it off, use it again, pay it off, use it again. It's like a credit card, but it's a line of credit tied to your house, the value of your house. And so I love HELOCs for a couple reasons. Number one is they're usually way less expensive interest rate wise than credit cards. So if you have a major purchase to make, it's not a bad idea to do it from a HELOC line of credit rather than a credit card line of credit, because your interest rate is going to be much, much lower and it's going to be less expensive over the long term, number one. Number two, check with your tax prep person. And I know the tax rules change constantly, but normally the interest that you pay on home equity credit is tax deductible, where interest on credit cards is not tax deductible. So that's definitely something that's compelling, especially if you were going to take out the line of credit anyways, is getting the additional benefit of the tax deductibility. The thing that I want to caution you about, and this is something that I'm sure the people watching this are like, you better say this, John, you better say this, or you're not being fair. There's pros and there's also cons. One of the cons is if you default on a home equity line of credit, you're going to lose your house, because your house is essentially guaranteeing that you're going to make your payment on that. It's almost like not paying a car loan. You're going to lose your car. It's almost not like paying your primary mortgage. They're going to take your house. So because it is a secured loan, you are putting that asset at risk. And in this case with HELOC, it's the house. Now, the whole purpose of this video is to talk about whether or not using a home equity line of credit is a good idea to pay off credit card debt. Well, the question is this: would your credit card debt be less expensive if it was actually home equity line of credit debt? The answer is almost undoubtedly yes. The average interest rate of credit cards varies over time, but it always tends to be kind of around 17%. That is way higher than the interest rate you're paying on almost any other extension of credit, unless you're using payday loans or pawn shop loans or title loans or any of the other asset-based loans that are just ungodly expensive and consumer advocates just hate. The home equity interest rate is probably, and again, it varies over time, but it is absolutely going to be in the mid to low single digits. So right there right out of the gate, you know that the amount you're paying in interest, if you're paying interest at all, which isn't great, but if you are, it's a whole lot better to pay interest rate at 6% than it is to pay it at 17%, right? You're saving a boatload of money, and then you add on top of that the tax deductibility of that interest, and then the effective interest rate even becomes lower because it's actually helping you, because it's lowering your taxable income at the same time. So these are all good things. It's you know what it is? It's making the best possible outcome out of a bad situation. The bad situation is clearly credit card debt. So I give it 2 thumbs up to the extent that you're looking for a thumb, the number of thumbs from me. I do like the idea of using HELOCs to pay off credit card debt, but you've just got to be cognizant that defaulting on a HELOC is different than defaulting on a credit card. Defaulting on a credit card is horrible. Defaulting on a HELOC means you're going to have to find somewhere else to live. So hopefully I didn't scare you away from using the HELOC. If you make your payments on time, it's perfectly fine. And it's a reoccurring line of credit, so you're never going to lose it. So if you have any other questions about this, drop them in the comment section below. Thank you for watching. Have a great rest of your day.
For more videos and credit tips from John Ulzheimer, go to www.tradelinesupply.com.